rents are actually falling in parts of the United States right now. After years of wicked increases with some cities seeing rents jump 20 to 30% since 2020, we're finally seeing a downward trend. National rents are down about 1.4% to 1.5% year over year. Cities like Austin have seen rents fall by over 6% in just 1 year. And in some markets, rents are down over 20% from their peak. But here's the twist. Not every city is seeing relief. Some places, like parts of the Midwest, are still going uppy. So what's actually happening? Before we break this down, welcome to Milton's Ghost. On this channel, we break down housing using real data, not headlines. We know markets move for reasons. Let's find them together. If you want real estate insights backed by actual data, hit like and subscribe. The biggest reason rents are dropping? We built too much housing in the wrong places. Remember, the undisputed champ is the law of supply and demand. High rent prices are the incentive for investors to build. From 2020 to 2022, developers recognized high demand and rushed to build apartments. At the time, cheap interest rates made projects easy. Now those units are finally hitting the market. And the result? Vacancy rates are surging in some cities. National vacancy is around 7 to 8%. This is nearing a multi-year high. Some cities like Austin have hit 14.8% vacancy rates. For investors, it is a disaster. For renters, it means they finally get a break from soaring rents. A situation like this creates competition. When landlords compete, they drop rents and offer concessions. This is why rents are falling hardest in Sunbelt cities like in Florida and coastal Texas. Fast-growth metros like Dallas, Phoenix, and Austin. And other places that overbuilt during the pandemic. It's not just supply, demand is weakening too. Here's what's happening after years of rent increases. Incentives created adaptations. People are doubling up. More people are getting roommates, more shared housing. 2. Uneasy job growth. In economic uncertainty, people don't move. 3. Rent fatigue. People literally can't afford increases anymore. When rent rises over 35% of a renter's income, they start to cut back on essentials because they can't afford everything. At that point, rent becomes a burden, and they start looking to reduce their expenses and lower their rent. This is referred to in all types of markets as demand destruction. Right now, about 50% of renters are cost burdened. That means they are spending more than 30% of income on rent. Rent growth has slowed dramatically compared to 2021-2022. So, even though rents are still high, the ability to pay higher rent is breaking down. Here's something most people miss. The rent declines are happening mostly at the high end. Why? Because that's what got built. Developers focused on luxury apartments, high-margin units, and amenity-heavy buildings. Now there's too many of them, and landlords are cutting deals. The amenities might include free months of rent, lower overall rents, and move-in specials. These are the economic incentives that drive consumers. We refer to this as microeconomics. Meanwhile, lower-cost housing is still tight. That's why rent relief is uneven, and some people won't feel it at all. Now here's where it gets interesting. While rents are falling nationally, some cities are still raising rents. For example, in the Midwest and Northeast markets are tightening, and rents have risen between 2 and 4%. Like we discovered in my last video, cities like Omaha are looking to force rent controls on some units in new developments. The opposite situation is true in cities like Omaha. There has been less construction. They didn't overbuild. Lower vacancy. Fewer available units means higher prices, like we discussed in my other videos. Supply and demand are the primary drivers of price. The government can't give you better prices. It isn't less greedy landlords. It is supply and demand. To be sure, Omaha rents have increased between 2 and 4% over the past year. Midwest job growth is increasing again. For example, in Omaha, unemployment is 3.3%, with 1% annual job growth. So instead of oversupply, they have undersupply. Let's zoom in on Omaha because this tells the full story. Unlike many cities, Omaha rents are still rising. The average rent is from $1,300 and $1,450 per month. This is 4.2% higher year over year. The vacancy rate is only 6.3%, lower than the national average. Even more interesting, rent growth hit 3.4% recently, beating national trends. Expected growth is still around 4% annually. What this tells us, Omaha didn't overbuild, so instead of falling rents, you're seeing steady increases driven by demand. The job market is strong, supply is limited, and vacancy is low. Demand is strong, supply is on the low side. These are the exact opposite of cities like Austin. So where are rents headed? Here's the reality. In the short term, rents likely stay flat or fall slightly in oversupplied cities. Medium-term construction is slowing, and in time, supply will tighten again. Long-term housing shortages are still real, which means rent relief is probably temporary. So here's the bottom line. Rents are falling where supply exploded. Rents are rise where supply is tight, and nationally, we're in a weird transition phase. If you want to understand where prices are going next and how to take advantage of it, check out my other videos right here, and don't forget to like the video and subscribe to the channel. Most channels will tell you the housing market is complicated. This one tells you why. Every video breaks down the incentives, the rates, and the policy, so you can see what's actually driving prices. If that's the kind of analysis you want, check out my other long-form videos.